Do you want to maximize your tax returns? Well, you're in the right place. Today we're going to pull back the curtain on the world of taxes. But before we do that, let's set the stage. Taxes, as we know, are a necessary part of our financial lives. They fund our public services and infrastructure. But when it comes to individual finances, they can be quite the conundrum. That's where tax returns come into play. They're essentially a summary of the income you've made over the year and the taxes you've paid on it. Maximizing your tax returns means ensuring you're not paying more than you ought to. And that's something we all want, isn't it? In this video, we'll explore how to understand your tax bracket, ways to reduce your taxable income, how to take advantage of tax credits, and the importance of filing your taxes correctly. So sit tight as we dive into the world of taxes and learn how to get the most out of your returns. Scene script. First things first, you need to understand your tax bracket. Diving straight in, a tax bracket is a range of incomes taxed at a given rate. Tax brackets are part of a progressive tax system where tax rates progress from low to high. For instance, if you make $30,000 a year, you won't be taxed at the same rate as someone making $300,000 a year. The higher the income, the higher the tax rate, but only on the income that falls within that bracket. Now, why is it important to know your tax bracket? Well, knowing your tax bracket can help you make informed decisions about your finances. Your tax bracket can influence how much tax you'll owe at the end of the year. And it can also affect your financial planning. For instance, if you're on the cusp of a higher tax bracket, you might want to make some strategic decisions to stay in your current bracket, like increasing your retirement contributions. It's crucial to remember that the US uses a progressive tax system. This means that not all of your income is taxed at your highest tax bracket rate. Only the money that falls within each bracket is taxed at that rate. So if you're in the 24% tax bracket, it doesn't mean that all of your income is taxed at 24%. Only the portion of your income that falls into the 24% bracket is taxed at that rate, while the rest is taxed at lower rates. So how do you figure out your tax bracket? It's quite straightforward. The Internal Revenue Service, or IRS, releases tax bracket ranges each year. You can find these easily online. You just need to know your taxable income, that is your total income minus any deductions or exemptions. Once you have that number, you can locate it within the tax bracket ranges to find out your tax bracket. Now that you know your tax bracket, it's time to explore how you can reduce your taxable income. Reducing your taxable income is a great way to maximize your tax returns. Now, you may be asking, how exactly do we go about this? Well, there are several strategies that you can employ. Firstly, consider contributing to your retirement accounts. When you put money into a traditional IRA or a 401k, it's pre-tax dollars that you're investing. This means that every dollar you contribute reduces your taxable income by the same amount. So, if you're in the 25% tax bracket, for example, every $100 you contribute to your retirement account effectively saves you $25 in taxes. That's a good deal, isn't it? Next, let's talk about health savings accounts, or HSAs. If you have a high deductible health plan, you're eligible to contribute to an HSA. The beauty of these accounts is that the contributions are tax deductible, the growth is tax-free, and withdrawals for qualified medical expenses are also tax-free. It's a triple tax benefit. So by contributing to an HSA, you're not only providing for future healthcare costs, but you're also reducing your current taxable income. Now, onto itemizing deductions. This strategy involves tallying up all of your deductible expenses throughout the year and then subtracting them from your income. Common deductions include mortgage interest, state and local taxes, and charitable contributions. However, keep in mind that itemizing only makes sense if your total deductions exceed the standard deduction. Finally, there's the option of tax loss harvesting. This involves selling investments that have declined in value to offset capital gains on other investments. While it may seem counterintuitive to sell off losing investments, it can be a savvy move when it comes to reducing your taxable income. Remember, every dollar you can shave off your taxable income is a dollar that's working for you, not for the taxman. By using these strategies and planning ahead, you can optimize your taxes and ensure you're keeping as much of your hard-earned money as possible. By reducing your taxable income, you can significantly increase your tax returns. Tax credits are like gold mines when it comes to maximizing your tax returns. They're essentially a dollar-for-dollar reduction of your tax liability. Unlike tax deductions, which merely lower your taxable income, tax credits directly cut down the amount of tax you owe. This is what makes them a potent tool in the hands of astute taxpayers. You can think of tax credits as coupons provided by the government, redeemable against your tax bill. If you owe the government $2,000 in taxes but have a tax credit of $500, you only need to pay $1,500. That's the power of tax credits. Now let's delve into some common tax credits that you can potentially leverage. First up is the Earned Income Tax Credit. This is a refundable tax credit for low to moderate income working individuals and couples, particularly those with children. The amount varies based on income and number of children, but it can be a significant boost to your tax return. Next, we have the Child Tax Credit. This credit is available to parents or guardians of children under 17. The credit amount has been substantially increased in recent years, making it a substantial benefit for families. The American Opportunity Tax Credit is another one to keep an eye on. This is specifically designed for students in their first 4 years of higher education. It can cover expenses like tuition, fees, and textbooks, making it a boon for those pursuing their educational dreams. Lastly, there's the Lifetime Learning Credit. Unlike the American Opportunity Tax Credit, this isn't limited to the first 4 years of college. It's available for any post-secondary education and even for courses to acquire or improve job skills. These are just a few examples. There are numerous other tax credits related to things like energy efficiency, adoption, and elderly care. Remember, tax credits can significantly reduce your tax bill and help you maximize your returns. So always keep an eye out for these opportunities and make sure to take full advantage of them. Filing your taxes correctly is crucial to maximizing your tax returns. Now, let's dive into the common mistakes people make when filing their taxes and how to avoid them. First up is neglecting to report all income. Every penny earned, whether through a job or a side hustle, needs to be reported. Keep track of all your income sources and ensure they're reflected on your tax return. Overlooking this step could lead to audits, penalties, or worse. Next on the list is misunderstanding deductions. Deductions can significantly reduce your taxable income, but they're often misunderstood or misused. It's important to understand what deductions you're eligible for and how to claim them correctly. Don't overestimate deductions or claim ones you're not entitled to, as it could trigger an audit. Another common mistake is math errors. Simple arithmetic mistakes can lead to major discrepancies in your tax return. Double-check all calculations and consider using tax software or a professional tax preparer to avoid these errors. The fourth mistake is using the wrong filing status. Your filing status impacts your tax rates and the credits you're eligible for. Make sure to select the correct filing status that best fits your situation, be it single, married filing jointly, or head of household, among others. Finally, the most common and detrimental mistake is missing the filing deadline. Filing your taxes late can result in hefty penalties and interest charges. Mark your calendar for the due date, which usually falls on April 15th. If you need more time, consider filing an extension. But remember, an extension to file is not an extension to pay. By avoiding these common mistakes, you'll be on your way to filing your taxes correctly, saving money, and avoiding unnecessary stress. Remember, when it comes to taxes, accuracy and timeliness are key. So take your time, double-check your work, and don't hesitate to seek help if needed. Filing your taxes correctly can save you a lot of headaches and help you get the most out of your returns. So let's get to work and make sure those tax returns are in tip-top shape. So we've covered a lot of ground today. We've taken a deep dive into the world of tax returns, explored the importance of understanding your tax bracket and how it impacts the amount of tax you owe. We've also talked about strategies for reducing taxable income, like maximizing your deductions and taking advantage of tax-saving opportunities. We've shed light on the benefits of tax credits and how they can significantly reduce your tax liability. Lastly, we've emphasized the importance of filing your taxes correctly to avoid any potential issues or penalties. In essence, it's about being proactive, not reactive. It's about understanding how the tax system works and how to make it work for you. The more you know, the better equipped you are to maximize your returns. Remember, the key to maximizing your tax returns is understanding how the system works and making it work for you. Thanks for watching.